Hey everyone, welcome back to Chipstock Investor. I'm Casey, and I'm jet lagged.
You have you look and sound like you have jet lag. I'm sorry. Um, I'll pick up the slack for you today.
I hope you do. Hope you guys are ready for Nick. More Nick talk.
I'm
Nick explain.
I apologize for that, for a lot of long-winded rambling from me today.
We had this subject on a recent CSI live event. What are OEMs and ODMs, and what is their business model? OEMs, original equipment manufacturers, ODMs, original design manufacturer.
Big hit, big spoiler. A lot of it has to do with AI. So that's cool. The AI trade is it's a thing again. It's making a comeback.
All of the research that we conducted about these OEMs and ODMs, including Celestica, we did with our partners at fiscal.ai. No, we don't have a new sponsor. That's FinChat's rebranded, upgraded name and logo, fiscal.ai/CSI. That code gets you 15% off any paid plan. You're going to see a lot of their charts in this video, in all of our videos, in fact, and in all of our research. Check them out now for your research process, fiscal.ai/CSI.
OEMs and ODMs. Well, we'll talk about definitions here just momentarily, but we're talking about the electronics supply chain. We're talking about the very top of the market. These are really, really big, massive markets, trillions of dollars a year in end market sales. Just to give you an idea of what kind of money we're talking about here for these OEMs and ODMs, electronics alone, couple $1 trillion globally every single year in end market sales. And that's just the IT sector. If you expand that to things like aerospace and defense, the medical industry, medical devices, many trillions of dollars in revenue up for grabs. So that's what we're dealing with. Here's what this looks like from the semiconductor industry flow point of view. We're talking about those end market tech equipment and devices that utilize chips to make it all possible. So we're not going to actually be talking about semiconductors today. We're going to be talking about the actual assembly of the parts and pieces that chips make. We're going to also talk about our end market sales as well. And the reason for that is when we're talking about electronics manufacturing, we're talking about the very end of the end market before these devices get sold to consumers. Think of this as like the most downstream part of the river. If you think of the supply chain about a river, this is where the river meets the ocean, the very large ocean. These sales cycles are very indicative of what's going to happen to all the other companies upstream. So yes, the tech giants that utilize these electronic parts for their services, the semiconductor manufacturers and designers themselves, the equipment companies, the fab equipment companies, all of it. So what we've been looking at this year is a reacceleration of the AI and accelerated computing market. We've had these kind of sluggish recoveries in consumer and enterprise markets, and then possibly a start of a new growth cycle for auto and industrial. But by and large, things have not been going super well. Let's talk about OEMs and ODMs. What is an OEM? What is an ODM? So an OEM, original equipment manufacturer. These are companies that make a final product based on the design of the customer. So they're not doing any of the design work. They just get the design from the customer and then they build it. So it's completely on the customer to make sure that the design happens. They have ultimate control over creative decisions, control of the product. And so an example of this would be Hon Hai Precision Industry, or Foxconn, making Apple products. Another OEM example would be Amphenol for things like data center cables and connectivity parts. Let's move to ODM, original design manufacturer. These are companies that make their own design and manufacture the product. And when they sell the product to the customer oftentimes white labels it. They stick their own brand name on it. So there is more limited control for the customer itself, There's a little bit of customization available there, but pretty easy relationship for the ultimate customer to work with because the ODM is handling the design and the make of the product. So an example of this would be a company called Quanta Computer, also based in Taiwan, like Foxconn. It is the world's largest PC and laptop manufacturer. They handle a lot of work for companies now. I think all of the top 10 PC and laptop manufacturers work with this Quanta Computer. So that would be an example of an ODM. Also, Super Microcomputer has some elements of ODM in its business model as well. OEMs and ODMs, trillions of dollars in annual sales up for grab, lots of revenue because they can cover literally anything. PCs and laptops, of course, smartphones, wearable devices, data center servers, car parts, medical devices, aerospace and defense, robotics, the list goes on and on. And in all actuality, there are some blurry lines between what an OEM and an ODM is. Many of them do both. There's another company here that we're going to focus on as well, an EMS, electronics manufacturing service company, that is like another contractor in the mix that oftentimes works for an OEM or an ODM, making basic parts like circuit boards and maybe assembling circuit boards into modules and electronic components. And jabil is an example of an EMS. Some of these EMS companies are themselves also becoming ODMs. So for example, Celestica is a company that is an EMS that has been branching out into OEM and ODM territory. If you haven't seen it, we did have this list of OEM and ODM providers and EMS providers in Discord. Check those out under the industry stock lists section.
Speaking of industry stock lists, we have a number of these over on our Discord server. You can get access to those and all of our research via a Semiconductor Insider membership. You can find that membership over on our website, www.chipstockinvestor.com. Sign up there today to get access to our Discord server where we have everything.
Tons of content over there. All things technology and then some, as well as lots of content on just good investing basics, like how to do it, how to invest in the first place. Check it out.
See you over there.
Let's just walk through this, how this relationship works a little bit. We made a flow chart within the manufacturing supply chain flow chart. So you have these OEMs and ODMs making electronic devices, and then we threw the EMS acronym in there as well. Here's basically how it works. So OEM or an ODM, they have this design. Either the customer provides it or they've designed it themselves in-house. And so they know what the product looks like. They know what parts they need. And so they hire an EMS, electronics manufacturing service provider, to go make some of those parts and assemblies. They get those parts from the EMS company, and then the OEM and ODM is basically just assembling those parts together. If you go to some of the websites of these OEMs and ODMs, you'll often see on their site that they offer what's called supply chain services. This is basically what they're talking about. They're doing the product assembly of these parts and pieces, and oftentimes they're also subcontracting out manufacturing of some of these parts. So it's a manufacturer managing manufacturers. And then the OEM and ODM does the final assembly and then makes the end market sale to the customer.
We get a lot of questions about some of these companies, especially at the beginning when we started the channel about Celestica and jabil. It seems like they make so much in revenue. And I think that's what we're going to talk about next, Nick, right? Does all of these companies are in end markets worth trillions of dollars. Mm-hmm. Their revenue is very, very high, but does that make these companies investable? And I think that's what we're moving on to next, because the revenue is high, but is it profitable?
We should start with Foxconn then, right? One of the biggest manufacturers on the planet, made famous by Apple, of course. And this is denominated in US dollars. So just based on these numbers, you would think Foxconn should be valued as one of the largest companies on the planet. And yet it doesn't crack into that list in spite of $240 billion per year in the last 12 months in actual sales. And the reason why it's not valued that high is those little bars on the right of the revenue bar. Net income, 5.8 billion. Free cash flow was actually negative. So this is by and large why we find the OEMs and ODMs an uninvestable asset for us personally. For this reason right here, tons of revenue, tons of sales. It's easy to muscle in and get a cut of these markets worth trillions of dollars, but it's very difficult to turn a consistent profit in this business. Shall we look at another one? So here's one that actually kind of breaks the mold. I mentioned Amphenol earlier. Still not the highest profit margins, but quite a different story from Foxconn, right? Amphenol, much steadier growth. Some of that is because of the frequent acquisitions that Amphenol makes, and it's just inherent in their business model. But both on a GAAP net income and free cash flow basis, see the difference in profit margin? If you just calculate it, just take the GAAP net income of the last 12 months, 2.6 billion, divide it by 16.8 billion. It's a more than 10%, mid-teens net profit margin. So this one breaks the mold. Many of these companies in the OEM, ODM space, I mean, they're doing really well if they generate a 5% margin. Amphenol, like more than double that. So this is one that's within the investable universe, chip stock investor investable universe for that reason alone. We'll get back into this here momentarily and talk about operating leverage and why we're looking for generally higher profit margins than what the OEMs and ODMs can consistently generate. But Amphenol is an exception.
And what about Celestica? Because Celestica is branching into more of that ODM territory versus just the...
Here's the chart for Celestica. Fun fact, this is a spinoff from IBM back in the early mid-1990s. So they've actually been around for a long time. This is a pretty tiny OEM, ODM in the grand scheme of things, $10 billion a year. These are big numbers, but it's a small company because of those tiny profit margins. Roughly 400 million in net income in the last 12 months, roughly 300 million in free cash flow. And this is why Celestica is getting a lot of attention lately. Part of their growth story is, yes, they participate in AI data centers. They have customers. They make networking servers for some of their data center hyperscaler customers, but they're that EMS provider. They're not historically building the final product. They're assembling some of the parts and pieces. They're like the subcontractor of the contractor. But as they branch out into the ODM model, they are hoping to generate high single digit or maybe even low teens profit margins, kind of like Amphenol. So this is part of the story for Celestica and why it's gotten so much attention in the last year. Of course, the stock price is reflecting that, and some investors think that this is going to be a really successful story, but this is why Celestica is catching some investor optimism, some hype.
So are Arista and Pure Storage then considered an OEM or an ODM?
No, they're not. But simply, no, they're neither. Think of these companies as like the fabless model of the OEMs and ODMs. So just in the same way that NVIDIA and AMD and that whole batch of companies figured out that if they just focused on engineering chip designs, they could actually gobble up the most profitable part of what it means to be a chip designer and offload the manufacturing to a third party like TSMC, which has become a massively successful business in its own right, but that's a different story. But you can think of Arista and Pure Storage in terms like that. They decided, instead of making these, in this case, Arista network servers, and for Pure Storage data servers, instead of making those themselves, they're only going to focus on engineering them and designing them. They'll manage the manufacturers and the supply chain. And then because they're these asset light, nimble businesses, they can also add some really, really big, hefty software business into the mix as well, because they have the capital to go out and do that. And so the benefit for the customer is they don't have to mess with off the shelf hardware and then trying to get it to work with whatever they're building. Arista and Pure Storage do all the design work. They handle the manufacturing via their subcontractors, and the customer gets this basically at the end of the day, after the hardware is installed in their data center or in their network, they just get a piece of software delivered to them. So like if you're an Arista customer or a Pure Storage customer, for the most part, what you're looking at the end of the day is just this really nice, clean software package. And you don't have to mess with any of the hardware behind the scenes.
And so that translates into a lot less revenue for Arista and Pure Storage versus a ODM or OEM like Foxconn, but significantly more profitable, right?
Yeah, absolutely. Just the same way as the fabless chip design model kind of works. Yes, if you get rid of your manufacturing, you have a lot less revenue to work with. However, you're offloading the lower margin part of the business and only focusing on the highest margin part of the business. And so here's Arista as an example, pushing well north of 40% free cash flow margins over the last 12 months. And really at times, even higher than that, like 50% or even more on a free cash flow basis. Pretty incredible. But this is roughly in line with what you would expect from a fabless chip designer too. This is not too dissimilar from how Arista Networks looked a decade ago, and especially before they had their IPO. I will say this, it's a similar business model, but remember Pure Storage does data servers versus Arista does networking. So it's a different product and there's going to be different caveats as a result to the businesses, but the business model itself is similar. Pure Storage trying to create that software-based platform for their customers. And so if you're a customer, of course, you can buy Pure Storage's data servers outright if you like. But for those that are purchasing all of that data storage as a subscription, the only thing you ever have to look at if you want is just the Pure Storage software management layer. And you handle all of your data needs directly through that interface without ever having to mess with hardware. Pretty cool. And theoretically, this can mean much higher profit margins for Pure Storage than any OEM or ODM, definitely more consistent revenue and profit than even an IDM memory chip maker could pull off. This is the theory behind it anyways. And actually, so let me go back to the original question. Why do we focus on this part of the market with companies like Arista and Pure Storage versus the OEMs, ODMs? We have the note in here about the higher margin helps manage the operating leverage two-edged sword. It cuts both ways. Let me just do like a hypothetical here, because Arista has had some cycles mixed in here. 2018, 2019 was kind of a cyclical down for Arista Networks. And you can see that there from 2019 to 2020, especially, they had like their first ever year-over-year decrease in revenue, and also profits fell, both net income and free cash flow basis. But because their profit margins were so high, overall, their profitability was actually pretty consistent. The margins dipped a little bit. And the result is theoretically a stock price that is smoother. Let me go back a couple more here and compare that with a company that has very, very thin profit margins. Like Foxconn has a bad year, like calendar year 2023 to 2024. You have thin profit margins to start with, and then you have a bad year. If your bad year results in like just a couple percentage points of margin decrease, that could be like a 50% drop in profit. If you go from 5% margin to 2.5% margin, that's only 2.5 percentage points, but it's a 50% drop in your profit margin. And so it ends up being a pretty wild ride as a result for a lot of these manufacturers. Celestica is another one. And this is why we're just kind of taking the stance of just letting Celestica do its thing. It would be fantastic if they pull it off, but it's not one that we're super interested in investing in because it's not proven yet. If they can consistently and sustainably keep those margins elevated, or if in a bad year, do they get their profit margins wiped out versus the smoother trajectory for an Arista or a Pure Storage.